Long wick candle. A long wick candle forms when price moves quickly in one direction, but gets rejected before the candle closes, leaving a small body and a long wick. In an uptrend, it means buyers pushed price up, but failed to hold it. In a downtrend, sellers tried to break lower, but got stopped. This shows hesitation and rejection at that level. What it means, one side is losing control. Reversal pressure may be building. How to use it? Look for this pattern near support or resistance. Don't enter immediately. Wait for confirmation like a momentum candle or structure break. Alone, it's just a warning. With confirmation, it becomes an entry signal. Multiple long wick candles. This pattern forms when two or more long wick candles appear at the same level. It shows repeated failure. Buyers or sellers try to break through and fail each time. In an uptrend, long upper wicks show resistance holding strong. In a downtrend, lower wicks show strong support. What it means, the level is rejecting price over and over. A reversal is more likely. How to use it? Watch for clusters of long wick candles at key zones. Enter after confirmation from price structure or momentum. The more rejections, the stronger the signal. Inverted long wick candle. An inverted long wick candle has a wick pointing against the direction of the trend. In an uptrend, a lower wick shows sellers briefly took control. In a downtrend, an upper wick shows buyers stepped in but failed. This type of candle shows sudden pressure from the opposite side. What it means, momentum is being challenged. The current trend may be weakening. How to use it? Use this pattern at strong levels. Wait for confirmation before entering. It works best with other signals like trendline breaks or momentum candles. Inside bar. An inside bar forms when a candle stays completely within the high and low of the previous candle. It signals a pause in the market. Buyers and sellers are indecisive, and price is coiling up. In an uptrend, it shows buyers are slowing down. In a downtrend, sellers are hesitating. What it means, momentum is stalling. A breakout or reversal could follow. How to use it? Look for inside bars near support or resistance. Don't trade them alone. Wait for the next candle to break the high or low of the range. Enter in the breakout direction only if it aligns with other signals. Consecutive shrinking candles. This pattern forms when candles get smaller and smaller, one after another. It often appears as price approaches a major level. In an uptrend, it means buyers are losing steam. In a downtrend, sellers are fading out. Each candle moves less than the one before. What it means, the trend is weakening. A reversal could be coming. How to use it? Watch for this pattern at key zones. If it ends with a rejection wick or a strong opposite candle, that's your confirmation. Enter after price confirms the direction shift. Candles. Increasing in size, this is the opposite of shrinking candles. Each candle grows larger than the one before. It usually appears after a reversal or breakout. In an uptrend, it shows buyers are gaining momentum. In a downtrend, it's sellers taking over. What it means, the market has picked a side and is accelerating. How to use it? Use this pattern as confirmation. If it follows a reversal setup, it shows strong commitment. Enter in the direction of the growing candles and ride the momentum. Candle color change. This pattern forms when several candles of the same color are followed by one of the opposite color. In an uptrend, a red candle after multiple green ones shows that buyers may be losing control. In a downtrend, a green candle after several reds signals that sellers are weakening. It's a subtle but important shift in momentum. What it means, the dominant side just got challenged. A reversal could be starting. How to use it? Look for this pattern near strong levels. It's more powerful if it comes after long wicks or shrinking candles. Use it as a warning sign and wait for confirmation before entering. Momentum candle. A momentum candle is a large-bodied candle that closes near its high or low with little to no wick. It follows a stall or reversal and shows that one side has fully taken control. In an uptrend, it means buyers are stepping in hard. In a downtrend, it confirms aggressive selling. What it means, momentum has returned. The trend is likely to continue. How to use it? Don't enter based on size alone. Use it after a reversal setup or key level rejection. When it confirms direction, enter with the momentum and manage risk carefully. Trend trade in uptrend. This setup forms when the market is clearly trending up and price pulls back to a major level. That level might be a support zone, trend line, moving average, or fib level. Once price touches it, you look for candlestick confirmation, like long wicks, shrinking candles, or a color change. What it means, the pullback is likely ending. Buyers are stepping back in. How to use it? Wait for the right pattern at the level. Once price confirms with momentum, enter long. You're trading with the trend, not against it. Trend trade in downtrend. This pattern appears when the market is in a clear downtrend and price pulls back to a key resistance level. That level could be a previous support turned resistance, a trend line, a moving average, or a fib retracement. As price returns to that area, look for bearish candlestick signals like long upper wicks, shrinking candles, or a color shift from green to red. What it means, the pullback is ending and sellers are likely to step back in. How to use it? Wait for confirmation. Ideally a momentum candle or a break of a short-term trend line. Enter short once the pattern confirms and manage your stop above the pullback high. Reversal trade in uptrend. This setup forms when price is trending upward but starts showing signs of exhaustion near resistance. You might see long upper wicks, an inside bar, shrinking candles, or a strong red candle after several green ones. These signs show that buyers are losing steam and sellers are stepping in. What it means, the uptrend is weakening and a trend reversal may be starting. How to use it? Wait for confirmation like a break of a short-term trend line or the appearance of a bearish momentum candle. Once that shift happens, enter short and aim to catch the early move down. Reversal trade in downtrend. This pattern forms when price is trending lower but starts showing strong reaction near a support level. You may notice long lower wicks, multiple rejections, or a green candle after several red ones. The market is hinting that sellers are losing power. What it means, a bottom may be forming and buyers could be preparing to reverse the trend. How to use it? Watch for confirmation like a break of a minor trend line or the appearance of bullish momentum. Once the structure shifts, enter long with a stop below the recent low. Reversal continuation trade in uptrend. This setup happens after an uptrend breaks down and starts to reverse, but gives a second chance to enter the new downtrend. Price first forms a top, maybe a double top or long wick rejection, then breaks structure and creates a lower low. After that, it pulls back to the new resistance zone. At that level, look for bearish candlestick patterns like long upper wicks, shrinking candles, or a momentum candle down. What it means, the market has shifted from bullish to bearish, and this is the retest before continuation. How to use it? Wait for candlestick confirmation on the pullback, then enter short to catch the next leg down in the new trend. Reversal continuation trade in downtrend. This setup is the bullish version of the same concept. After a downtrend breaks structure and forms a higher high, price pulls back to retest the breakout area. That zone often lines up with previous support, a trend line or a fib level. At the pullback, you'll look for bullish candlestick confirmation, such as long lower wicks, color change, or a strong green momentum candle. What it means, the market is reversing upward, and this is the first real entry point after the trend shift. How to use it? Wait for confirmation on the pullback, then enter long in the direction of the new trend. Multi-timeframe trend trade. This entry combines everything you've seen, but adds a second layer of confirmation. First, you identify the setup on a higher time frame, like a trend, a pullback, and a key level. Then when price reaches that level, you drop down to a lower time frame to look for candlestick confirmation and a local trend change. What it means, you're trading with the higher time frame but using the lower time frame for a precise entry. How to use it? Mark your zone on the higher time frame. Drop down to a lower chart and wait for reversal candles or a mini trend shift. Enter early with better risk to reward. Multi-time frame reversal trade. This setup uses two time frames to confirm a reversal. First, on the higher time frame, you spot a rejection candle, maybe a long wick, as a cluster of wicks, or a candle color change at a key level. But instead of entering immediately, you drop to a lower time frame and wait for a local trend shift, like a break of structure or reversal pattern. What it means, the higher time frame is showing rejection, and the lower time frame confirms the actual reversal. How to use it? mark your key level on the higher chart. On the lower time frame, wait for a double bottom, trendline break, or momentum candle. Once that shift happens, enter in the new direction with tighter risk and better timing. False reversal. A false reversal happens when a strong candlestick pattern forms at a key level, like a long wick or multiple rejections, but price breaks through anyway. It traps traders who enter early without confirmation. These fakeouts often occur when stop losses are tightly placed just below the pattern, and smart money forces a move to grab liquidity. What it means: not all candlestick setups lead to reversals. If there's no trend shift, the pattern is likely to fail. How to use it. Never enter just because you see a rejection. Always wait for a confirmed shift in momentum or structure. If price breaks below the pattern with a strong candle, step aside. That setup is invalid. Imperfect trade. An imperfect trade happens when there are multiple support or resistance levels stacked close together, forming a zone instead of one clean line. Price may react inside, above, or just outside the zone. Waiting for perfect alignment often leads to hesitation and missed trades. What it means: strong levels don't always react with precision. The entire area should be treated as potential. How to use it. Mark a zone instead of a single level. Look for rejection candles or trend shifts anywhere within or just beyond that zone. Confirm with a lower time frame reversal. You're not trading the exact price, you're trading the reaction in the zone. Subscribe to Trading Strategist, the new best trading channel on YouTube, and like this video. I'll see you in the next one. Just a reminder, I'm not a financial advisor. This video is for educational purposes only, and any results depend on your own decisions and actions.